Welcome back to Accounting 201. This is Daryl Green, and I like to spend this time speaking about the different forms of businesses, particularly a proprietorship, partnership, and a corporation. A business entity can take one of three legal forms: proprietorship, partnership, or a corporation. Now, each one of those businesses have their own unique attributes. And if we look here at the different attributes, one owner allowed. A proprietorship can have one owner. A partnership, no. It has to be at least two people. Corporation can have one owner. A proprietorship is not taxed. That is a pass-through entity, meaning that is the taxes go right to the individual that owns the proprietorship. The same thing with a partnership. The partnership is not taxed itself. The actual partners are taxed. A corporation does incur taxes. There's limited liability only if the proprietorship and partnership is set up as an LLC. If not, then there is no limited liability. The proprietorship, those individuals running the proprietorships are liable, as well as the partnership for any debts. And with the corporation, there is limited liability, meaning that the corporation is liable and not the individuals that are running the corporation. In terms of a business entity, all three forms of business are business entities. A proprietorship and partnership are not legal entities because, again, those revenues and those liabilities are passed through to the individuals that are running the proprietorship and the partnership, but a corporation is a legal entity. There's an unlimited life with a corporation, meaning that the corporation can continue going on even if someone leaves the corporation. But with a partnership and a proprietorship, once those individuals that are running those different businesses are no longer with the organization, then they have to start a whole new proprietorship or partnership. Sarbanes-Oxley is was created in order to have stringent controls or internal controls within organizations. And here is just a look at some of the different companies and some of the problems that those companies had in terms of how they recognized their revenue, how they recorded their expenses, some of the things that they actually did in order to cause problems for those organizations. And therefore Sarbanes-Oxley came up with stringent internal controls to try to prevent some of these things from happening. Okay, the Dodd-Frank Wall Street Reform and Consumer Protection Act was designed to promote accountability and transparency in the financial system, put an end to the too big to fail concept, protect the taxpayer by ending bailouts, and to protect consumers from abusive financial services. Here we have just an overview of some of the principles, assumptions, and constraints that we actually went over with the last lecture. You can take a look at these and you can pretty much determine which one of these items are principles, assumptions, or constraints. Here's the different definitions of the four principles that we spoke about prior: the measurement, revenue recognition, expense, and the full disclosure principle. The assumptions: your going concern, your monetary unit, your time period assumption, as well as your business entity assumption. And then your two constraints: materiality and benefits exceeding the cost. Okay. Again, back to your different principles, assumptions, and constraints. If we take a look here, we see that materiality is a constraint, measurement is a principle, business entity is an assumption, going concern is an assumption, expense recognition is a principle, time period is an assumption, full disclosure and revenue recognition are both principles. Now let's take a look at the income statement and balance sheet. Let's get into some real detailed information here. When we're taking a look at our income statement, we notice that our fees earned are recorded in our credit column. If you notice, your left column is going to be your debit column, your right column is going to be your credit column. All revenues are going to be initially put into the credit column. All of your expenses are going to be debited into the debit column. Once we total all of our expenses up, we put those totals into our credit column and subtract those from our revenues. And as we can see, our total expenses of $17,300 subtracted from our $36,000 in revenues is going to give us net income of $18,700. Moving over to the balance sheet, we have our assets, our liabilities, and our stockholders' equity. Our accounting equation is assets equals liabilities plus stockholders' equity. If we add up all of our assets, our cash, accounts receivable, office supplies, land, and equipment, We have total assets of $116,400. Accounts receivable, that's when someone purchases items or merchandise from us, but they don't actually have the cash at this point, so we provide that merchandise to them on credit. They owe us money. Accounts payable, just the opposite. We go out and purchase inventory or merchandise. We don't have the actual money to pay for it. Therefore, we owe someone. So now we incur an accounts payable, which is a liability. Moving down to the stockholders' equity section, common stock, that is the stock that other investors they actually own within our company because they gave us money to actually help run our business. So we have common stock out there, which is equity. And then you also have your retained earnings, which is the money that we kept within the business after paying all of our expenses. So together, our common stock and retained earnings is going to comprise of our total equity. Notice that our total equity plus our accounts payable is going to equal what our total assets are, which is $116,400. Okay, let's move right along here. And let's just take a look at the accounting equation. The accounting equation, again, assets equals liabilities plus equity. Okay. If we expand that equation, we notice that equity consists of our contributed capital, which is the same thing as money that is put into the business, plus our retained earnings. Equity could also be common stock, which is stock that we actually gave out to individuals that invested in our business. We subtract any dividends that we paid, and the dividends are just simply thank yous to our investors. Our investors, they invested and they purchased common stock, but we made a lot of money. We decided we want to give dividends out to our shareholders because we want to keep them happy. We want them to continue to invest, and we want new investors to invest in our business. So we want to be a company that is known for paying dividends. Even though dividends are not required, it's nice to be able to pay a dividend because it shows that your company is stable and continuing to make money, because otherwise we would not be paying dividends. And if you take your revenues minus expenses, that's simply your net income. Okay, so your retained earnings is going to be your net income. And then also you're taking in consideration any dividends that was subtracted from your common stock. All of those things together are going to equal your equity. That equity along with your liabilities must equal what your assets are. Let's take a look at a couple of situations. We have two companies here. We have Bose and we have Vogue. Now we notice that equity is missing for Bose. We notice that assets is missing for Vogue. What we want to do is balance the equation out. If we know that $150 is our assets, our liabilities are 30, then we need a number to fill in the gap to equal what our assets are. So therefore, we're looking for that particular number that's going to add together with $30 to equal 150. And for Vogue, we know that our liabilities are $100, our equity is 300. So obviously, we're looking for a number that's going to add up to those two numbers, which would total and equal our assets. When we take a look here, $120 is the obvious answer. $120 plus $30 equals 150. And for Vogue, the $100 plus $300 in equity equals $400. So our assets must be $400. Moving down to the expanded equation, we want to take a look here. We see that revenues is missing from Nikon, and then for YouTube, we got the dividend payment, which is missing. So let's take a minute here and let's see if you can figure out what number should go in revenues and what number should go in dividends. Okay, let's see. Revenues, you got $60. $60 minus $40 in expenses is going to give us $20. That $20 plus the $100 in common stock is equals to $120 in equity. The $120 in equity plus the $80 in liabilities equals the $200 of assets. So therefore, our assets equals our liabilities plus our equity. Moving down to YouTube, the dividend payment was $10. So if we take the $220 minus the $10, that gives us $210. Our revenues of $120 minus our expenses of $90 gives us $30. So if we take the $210 plus the $30 in net income, That's going to add to $240 of equity. Plus your $160 of liabilities is going to equal $400 in assets. So we're balanced. Let's analyze the actual business transaction. Let's take a look here. This particular transaction, we have Chaz Taylor is going to invest $30,000 cash to start the company. The accounts that are involved is going to be your cash. So our cash is going to be increased by the $30,000, and our common stock, our equity is going to be increased. So he has common stock of $30,000 in the company because he put $30,000 of cash within the company. And this is how it would be set up. We go to our assets. Our assets are $30,000 cash. Go to the other side of the equation, and our equity is $30,000 of common stock. We're balanced. Now let's go out and purchase $2,500 worth of supplies. What's going to be affected? Well, our cash is going to go down because we're going to pay $2,500 for the cash, but our supplies is going to go up. In a situation like this, we don't move over to the other side of the equation. We stay on the asset side, and when one asset replaces the other, there's no need to move to the other side of the equation. Let's see. Okay, so as you can see, $2,500 was subtracted from our cash, but we also gained $2,500 in supplies. We had to do nothing on the other side of the equation because we balanced everything out by replacing one asset with another. Let's try another transaction. Let's go out and purchase equipment for $26,000 cash. What happens here? Again, we're going to replace one asset with another. So our cash is going to go down by $26,000, but our equipment is going to go up by $26,000. Again, as you can see, the cash was deducted by $26,000, and our equipment was actually increased by $26,000. We had to do nothing on the other side of the equation in order to stay balanced. Let's go out and purchase supplies on account this time. This time we're not going to actually pay cash. We're going to purchase on account. Our assets are going to go up for the $7,100 in supplies, but then we're also going to incur an accounts payable, which is a liability of $7,100 because we owe that money. This time we are moving over to the other side of the equation. As you can see, supplies have increased by $7,100. But also we incurred an accounts payable of $7,100 on the other side of the equation, which now we have a total of $37,100 in assets and $37,100 in liabilities plus equity. Okay, now let's take a look at transactions involving revenues, expenses, and dividends. Okay. We providing consulting services to a customer and receive $4,200 in cash right away. Accounts involved. We have cash that's going to go up at $4,200, and then our revenues are going to increase by $4,200 on the equity side. As you can see, our cash is increased by $4,200. All the way on the other side, revenue is increased by $4,200 under the equity section. We're balanced. Let's go ahead and pay rent of $1,000 and salaries of $700 to employees. Again, cash is going to go down because we're paying cash. The rent expense is going to go up as well as our salary expense is going to go up, which is going to cause our equity to go down. Take a look at that. Again, $700 or $1,000 of cash as well as $700 of cash is being spent. On the other side, that $1,000 of expense and $700 of expense is being deducted from our total equity. Remember that expenses will always decrease your equity. Okay, let's stop there. And when we come back next time, we'll go into a few more transactions and take a look at how we analyze those transactions in order to make sure that after each transaction, we are balanced with our equation. which is assets equals liabilities plus owner's equity. We'll see you next time.